How do Treasury bond terms like duration impact passive income? Imagine earning steady interest from government bonds while your investment quietly grows. That's the power of Treasury bonds in a passive income strategy. These bonds are debt securities issued by the government, paying fixed interest over a set period. They are popular because they offer predictable income with very low risk. Now, let's talk about duration. Duration measures how sensitive a bond's price is to changes in interest rates. Think of it as the average time it takes to get back your invested money through the bond's cash flows. For example, a bond with a duration of 5 years will see its price change about 5% for every 1% change in interest rates. It's important to note that duration isn't the same as maturity. Maturity is when the bond pays back the face value, but duration considers both the timing and size of all payments, including interest. So, how does duration influence passive income? Longer duration bonds usually pay higher interest rates. Investors demand more compensation for locking in their money longer and taking on more interest rate risk. This means, all else being equal, bonds with longer durations can give you larger interest payments, boosting your passive income. But there's a catch. Longer duration bonds are more affected by interest rate changes. If rates go up, their market value drops more sharply than shorter duration bonds. This price change doesn't affect the interest payments you receive if you hold the bond to maturity. You still get your fixed interest and principal back. However, if you sell early, you might get less than you paid. That's why for passive income-focused investors who plan to hold bonds until maturity, price swings are less of a concern. Shorter duration bonds pay less interest but are less sensitive to rate changes. Their prices stay more stable, which can be good if you want steady income and less risk of losing money if rates rise. These bonds are often preferred by investors who want safety and quick access to their money. Reinvestment risk is another factor. It's the chance that when interest payments or principal are returned, you might have to reinvest at lower rates. Shorter duration bonds face this risk more often because their payments come due sooner. If rates fall, future income could decrease, which is something passive income investors need to consider. If your goal is to maximize passive income and you're okay with some market fluctuations, longer duration bonds might be better. They give you higher interest payments, which can boost your income stream. But if you want more stability and expect interest rates to rise, shorter duration bonds can protect your principal and keep your income steady, even if it's smaller. Investing passively in Treasury bonds can be simple. You can buy individual bonds and hold them until they mature, or invest in Treasury bond exchange-traded funds that track a broad index. These strategies requiring minimal effort and let you collect regular interest payments without trying to time the market. In the end, understanding how duration affects your bonds helps you choose the right mix for your passive income plan. Longer bonds can give you more income but come with more risk if rates change. Shorter bonds offer safety and stability but less income. Your choice depends on your income needs, how long you plan to keep your investment, and your comfort level with market ups and downs. Knowing this helps you build a Treasury bond portfolio that fits your financial goals and keeps your passive income steady.